Hello. In this video, we're going to be talking how to account for short-term notes receivable. First, let's talk about what is a note receivable. So far, in the beginning part of this chapter, we've talked about accounts receivable. So now we're going to talk about the notes receivable. And if you recall, accounts receivable are informal credit arrangements, which means there's no formal arrangement or document between the buyer and seller. A notes receivable has a formal credit arrangement. There is some document or form that will specify the terms of the arrangement, including the amount, the date, the length of the arrangement, and the interest rate. When you have a notes receivable, you have a creditor, which is the lender, and you have a debtor, which is the borrower. And a notes receivable can be classified either as current or non-current, depending on how long the note will be outstanding. So if the note is outstanding less than a year, then it's going to be a current asset, versus more than a year, it's going to be a long-term asset. Let's talk about the short term. So these are for notes receivables that have shorter than a 1-year life. And a short-term bearing at note, a short-term interest-bearing note, because we're going to talk about non-interest. So right now we're going to be talking about the interest-bearing short-term note, and that consists of your principal plus your interest. It has those two components are going to be paid back. So the interest is going to be the face amount, which is what the receivable is going to be booked at. So let's just take an example of I am a company and I am going to lend essentially my customer $100,000 because they are unable to pay today. I'm going to lend them $100,000. I'm going to give them a full year to pay their invoice at a 10% rate, which is the market rate. Okay, and so therefore, they're going to pay me at the end of that 1 year. They're going to pay me the $100,000, which is going to be the principal amount, plus the $10,000, which is going to be the interest on it. So in total, I will receive at the end of the 1 year, I will receive $110,000. Let's go through an example for the interest-bearing note. It's important to know if you're working with an interest-bearing note or a non-interest. These are all interest-bearing. So Stridewell Wholesale Shoe Company manufactures athletic shoes. On May 1st, 2027, the company sold shoes to Harmon Sporting Goods. Stridewell, so this is the creditor, the lender, agreed to accept a $700,000 6-month 12% note in payment for the shoes. Interest is receivable at maturity, so which means we as the creditor, receive the interest at the end of the 6 months in this situation. And assume that 12% is an appropriate rate for this type of note. So how do we record that? Well, on May 1st, when we initially enter into the agreement, we made a $700,000 of sales, right? We provided $700,000 of sporting goods, I'm assuming it's shoes, to our customer, and our customer signed a note, and now we have a notes receivable for $700,000. That was on May. So fast forward 6 months later, right, the note is due. So the note was $700,000. So we debited notes receivable in May. So we have to credit notes receivable when it's paid off. Plus, they have to pay us interest on that $700,000. And that interest is calculated as $700,000 times the annual rate of 12%. But this was only for 6 months. So it's only for 6 out of 12 months. So our interest that they have to pay us is $42,000. So we have interest revenue, we record interest revenue for $42,000, and we actually receive cash for $742,000. So back to here, this is when we receive the payment, we receive the principal, plus we receive the interest in the interest-bearing note situation. Alternatively, same facts, except what if the sale occurs on August 1st, 2027, and it's also for 6 months, right, at 12%, but it kind of it goes through the actual year. So what we do here is the note is not due for payment at 12/31. It's due for payment, I think it's in February 1, I think is when the note is due, right? That's when we're going to collect on the, that's really messy. That's when we're going to collect on the note. That's when the note is due, and that's when we're going to receive the cash. However, because this has been for 5 months, from August, from 8/1 to 12/31, is we have the full month of August, September, October, November, December. So 1, 2, 3, 4, 5 months. We've earned that revenue because that note has been outstanding. So we've earned the $700,000 at 12%, and we've earned the revenue for 5 out of the 12 months. So it's $35,000. So at the end of the year, we would record an interest receivable for $35,000 and interest revenue for $35,000. And now comes February 1st, when we're actually going to collect on the note, because that's when it's due. We're going to receive the cash. Our cash is still the same, right? It's still the $700,000 plus the $42,000 of interest. It's the same amount of cash. So, and our notes, so this part is the same as before. Our notes receivable, when we recorded it here, this is on August 1st, we would have recorded a debit notes receivable, $700,000, credit sales revenue, $700,000. It would have been the same entry. It would have been the same as the May 1st entry. It's the exact same entry. It's just happening 3 months later. So we would still credit our notes receivable, $700,000. We have this interest receivable that we recorded at 12/31 that is being paid off. So we credit the interest receivable for $35,000, so it's no longer on our books. And then we credit interest revenue. So this is just for the 1 month, the $700,000, 12%. We earned interest revenue of 1 month, and it's the $7,000. So in total, we have earned the same amount of interest. It's the $42,000. We just earned $35,000 of it was recorded in 2027, and $7,000 of it was recorded in 2028 because we overlapped year ends. That was short-term interest bearing. Now we're going to talk about non-interest bearing. And when you say non-interest bearing, you're going to think, well, does that mean we have a note receivable but no interest? No, it does not, because no company would reasonably do that. Would you loan a customer $700,000 for 6 months or a year and not collect any interest? Everyone would want to take you up on that. So that's not a good business decision. That is not what is happening here. Non-interest bearing notes, they do have interest, except that the interest will say, it says interest is discounted from the face amount. So face amount is principal amount to determine the cash proceeds made available to the borrower at the outset. The outset is the beginning. So meaning if you're my customer, right, and I sell you shoes for $700,000, and you can't pay me now, so I'm going to give you a note receivable for we're going to enter into an agreement for $700,000. At the end of the 6 months, you're going to give me $700,000. However, at the beginning, at the outset, I'm not giving you $700,000 worth of goods. I'm going to give you less than $700,000 of goods, and that's where the interest is kind of embedded in there. And there's going to be, it's called a discount on the notes receivable, and it represents future interest revenue that will be recognized over time. Let's go through an example. It makes a lot more sense, I think. Okay. Similar facts. Stridewell Wholesale Shoe Company sold shoes to Harmon Sporting Goods on May 1st, 2027, accepting a 6-month, $700,000 non-interest-bearing note in exchange for delivering goods that have a cash sales price of $658,000. So this is kind of where it's different from the interest-bearing. We still, our customer still cannot pay us for whatever reason. So we're telling them they can pay us $700,000 in 6 months and a non-interest-bearing note. But instead of providing them with goods for $700,000, we're actually providing them goods only worth $658,000. So let's look at this May 1st entry. First, my notes receivable is $700,000. Why? Because at the end of the 6 months, I'm going to get me as a creditor, I'm going to receive $700,000 from you. And let's look at what did we book our sales revenue. Our sales revenue is $658,000. That's what we gave you. I gave you goods that have a cash sales price of $658,000. And so therefore, to make our entry balance, we have this new account, and it's called discount on notes receivable, and it's the $42,000 credit. This is a contra, another new contra account. It's a contra asset account against the notes receivable. And so when you present this on your balance sheet, you would say notes receivable net of discount $42,000, and you present it $658,000. Or you can present it notes receivable $700,000 less discount on notes $42,000 and net is $658,000. There's various ways that you can present it on the face of the balance sheet, but in any case, they're both the net receivable amount is what is actually going to be reported on the balance sheet. Okay, that was just a side note. So that's what happens on May 1st. On November 1st, the note comes due. Let's go to the second entry first. The note comes due. You're going to pay me $700,000. That's what my note receivable was for. That's what I had recorded. My note receivable was this $700,000. So I'm going to credit $700,000. Okay, so that's my one of my 2 entries on November 1st. 6 months later, I'm just going to draw that line a little bit better. It's not very straight. That's okay. Additionally, so now on my balance sheet, I have this discount account, this discount on notes receivable. It's a contra asset, and I booked on May 1st. It had a $42,000, right? That's what I booked on May 1st, $42,000. And now I have to, you've paid me back, right? So I don't have that, I should not have that note receivable on my books, nor should I have my discount, because really that discount represents interest. And now I've earned, excuse me, I've earned that interest because I've given you these goods without making you pay it for the last 6 months. So I'm going to debit right here my $42,000, and the credit is interest revenue because it's still that $42,000 represents interest. That discount represents interest that is embedded in the note itself. And so at the end of the day, whether you have an interest-bearing note or non-interest-bearing note, you still earned $42,000 of revenue, of interest revenue, but you've only received $700,000 of cash in the non-interest-bearing note. However, you only gave $658,000 of merchandise on the outset. Let's just say you got this problem, right? And said, You sold shoes to the sporting goods store on May 1st, and you accepted a 6-month, $700,000 non-interest bearing note in exchange for delivering goods that have a cash sales price of $658,000. So all the same facts as before. But now you're supposed to calculate what's the effective interest rate. Well, the way we do that is we take the interest for the 6 months. We know the interest amount in the situation. We just don't know the interest rate. And the way we figure out the interest amount is we take the principal amount of the note less the amount we provided or gave on the outset of the loan, of the agreement, on the outset of the agreement. So can barely read that, but that would be our $700,000 was our principal minus we only gave you goods for 658. So the interest embedded in there is 42,000. So you take that divided by the sales price. So 42,000 divided by 658,000 gives you this rate. This rate is only for 6 months because this interest is only for 6 months, right? And then to annualize it, you multiply by 2 and you get this effective interest rate of 12.766%. So it's not exactly the same 12% as before, but it's close. Now let's just highlight, just like the non-interest bearing note example, what if we made the sale on August 1st instead of May 1st? Well, on August 1st, our entry would not change from the May 1st entry. So our May 1st entry, if you can read all this, is we're going to record a note receivable because you're going to give me $700,000 at the end of the 6 months. We're going to record sales revenue of 658, and we're going to record this credit, this contra asset for discount on notes receivable. That's the same entry that happens on August 1st. In this example, we just don't collect on this note receivable till 2028, the following year. So on December 31st, we have earned 5/12 of that interest. So that's 700,000 times 12%. And we've now 5 of the 12 months have passed. So that gives us $35,000 of interest revenue. And so therefore we've earned this discount that that you've received. So we debit the discounted notes receivable. On February 1, 2028, when the payment is actually made, let's go again just to our second entry. You're going to give me cash of $700,000, and then I no longer have a receivable because you've paid it off. So I'm going to credit my notes receivable, which was recorded the face amount of $700,000. And now I've earned my last 1 month of interest of $7,000, and my discount on notes receivable is also debited. So on August 1st, if I look at my discount on notes receivable account, on August 1st, I recorded a $42,000 credit. That was on August 1st, right here when we entered into this agreement. On 12/31, I've earned $35,000 of it, and so that's 12/31, and then now on February 1, I've earned the other $7,000. So really, my discount notes receivable will be 0 at the end of it, at the end of February 1, after the note is paid off.